Hello, everyone. Thank you very much for joining us once again and welcome back. Today, we are discussing how to compute the taxable income. And before going to the main topic, as usual, we'll discuss recapping. We'll discuss the previous lecture very high level. At very high level, we'll go for the recapping. Then we'll start the lecture. If I'm going to start the seminar and a webinar and we are discussing recapping, till now we have discussed in our previous lectures, we have discussed till now overview of the corporate tax law. We have discussed resident and non-resident taxable persons. We have discussed exempt persons in our fourth lecture. We have discussed out of the scope persons in our fifth lecture. We discussed UE sourced income. We have discussed permanent establishment and the history of the permanent establishment. We have discussed corporate tax registrations. We have discussed applications of corporate tax on the partnership, applications of corporate tax on the free zones, and application of corporate tax on family foundations and trust. These are the topics that we have covered till now. If you're going through these topics, you will realize that all these topics were basically related to the scope of corporate tax. Basically, what is the scope of the corporate tax? On which businesses corporate tax is applicable, on which entities corporate tax applicable. So what are the resident person, what are the non-resident person, what are the exempt persons, what are the out of scope persons. To some extent, we have discussed the related income as well. We discussed like which income can be subject to tax, which income cannot be subject to tax. But overall, if I'm asking, overall, we have discussed the scope of the corporate tax. Basically, we can see the radar, which comes under the ambit of the corporate tax till now. And after discussing the scope of the corporate tax, while discussing the scope of the corporate tax, every time we'll discuss that every resident person, non-resident person, whoever comes under the scope of the corporate tax, they will be liable to pay tax on the taxable income. Or we said they will be liable to pay tax on the UE sourced income, or they will be liable to pay tax which is not, which the income on the income which is not 0%, they will be liable to pay tax. Basically, we discuss scope and to some extent income which will be subject to tax. And every time we said taxable income will be subject to corporate tax. Now the question arises, what is taxable income? Taxable income, to calculate the taxable income, it has been given in the UE corporate tax law that businesses needs to take the profit from the financial statement and they need to adjust those profit to arrive at the taxable income. Now the question arises, why we cannot take the profit which is reflecting into the financial statement? We can take the same profit, apply 9%. Can we do this? No, we can't do this. The reason is the rules and principles which are applicable to calculate the accounting profit, those are the different rules as per the IFRS, and rules and the principles which are applicable to calculate the taxable income. These are the different rules as per the UE corporate tax law. So UE corporate tax law has a different rules, IFRS has a different rules, accounting profit is calculated as per the IFRS rules, and taxable profit or taxable income is calculated as per the UE corporate tax law rules. It has been given in the law where there is a contradiction in between the accounting standards, accounting principles or tax principles. So tax principle will override the accounting principle. But the main thing is the rules are different. Rules are different to calculate the taxable profit. Rules are different to calculate the accounting profit. These rules create the differences. These differences can be of permanent nature. These differences can be of temporary nature as well. So basically, again, I'm repeating, accounting rules are different. tax rules are different. These rules are creating differences in the profits. While these creating differences, these differences can be permanent differences, or these differences can be temporary differences as well. So if these are the permanent differences, these differences will have impact in one tax period. These will not have an impact in the subsequent tax period. And the best examples are like capital gains. Capital gains is not subject to corporate tax, but capital gain is income in the books of accounting. So it will have impact in one tax period. It will not have any impact in the subsequent tax period. In the same way, fines and penalties. Fines and penalties usually are not allowed by tax authorities as an allowable expense. While in the accounting books of record, we will be allowed to deduct the fines and penalty to arrive at the tax accounting profit. In the same way, entertainment expenses has been given in the UE corporate tax law that 50% of the entertainment expenses are allowable expenses, while calculating the accounting profit, we will take 100% expenses as entertainment expenses as allowable expenses. The principle, so these three things specifically I mentioned, it will create permanent differences. Now coming back to the temporary differences. These temporary differences, these will have impact in one tax period. It will not have any impact in, it will have an impact in the subsequent tax period as well. So temporary difference, they will impact in the current tax period, subsequent tax period, there will be only temporary timing difference, overall financial impact will be same. So incurred in one tax period, it will have effect offset in the subsequent tax period. These temporary differences, it can be deductible temporary differences, little bit tricky words, technical words, it can be taxable temporary differences as well. So if these are the deductible temporary differences, your current period taxable profits will be higher than your future taxable profits. So current period taxable profits will be higher than the accounting profit. You will be liable to pay more tax now, but in the future, you will be liable to pay less tax. And this called bad debts provisions. Bad debts, usually these are allowed by tax authorities on actual basis, but in accounting record, bets are deducted on provision on the basis of provisions. So warranties, usually these are the examples that will create deductible temporary differences. In the same way, taxable temporary differences, in the taxable temporary differences, you will be liable to pay less tax now, but in the future, you will be liable to pay more tax. So the prepayments, if you are making prepayments, usually cash authorities follow cash basis of accounting. Whenever you are making prepayments, authorities will allow 100% prepayments right now. So assuming if the prepayments are 1 million, these 1 million will be deducted from your taxable profits, and these will be amortized in the accounting profit. Assuming over the period of 10 years, it will have impact of 10,000 in the accounting profit, but it will have impact of 100,000 in the taxable profit. Your taxable profit right now, it will be lower than your accounting profit. You will be liable to pay lesser tax now, but in the future you will be liable to pay more tax. So these are called taxable temporary differences. So first of all, I'm going to set the foundation. Why are we calculating the taxable income? How will it adjust? What is the reason behind this? The reason is the rules are different. These rules are creating differences. These differences can be permanent differences. These differences can be temporary differences as well. These temporary differences can be deductible temporary differences. It can be taxable temporary differences as well. So these are the bases due to which we are calculating, or we are mapping our accounting profits into the taxable profits. Now, while mapping the accounting profits into the taxable profit, there are two approaches. These two approaches are direct tax and indirect tax. Sorry, direct method and indirect method. Under the direct method, as usual, we are calculating sometimes cash flow as well on the direct basis of accounting. Under the direct method, we will calculate everything from the scratch. Like we will take sales, we will take the expenses, allowable expenses, we will arrive at the taxable profits or taxable income. This is a direct method. As I mentioned earlier here as well, we will take gross income, cost of goods sold, tax allowable expenses and deduction, any other taxable income, we will arrive at the taxable profits. This is the direct approach to calculate the taxable profits. It can be indirect approach as well. Indirect approach, we will take accounting profit, we will adjust the accounting profit to arrive at the taxable profits. Like we will take the indirect method, accounting profit will be base. So first of all, we need to prepare the financial statement. From the financial statement, we need to calculate the accounting profit. These accounting profit will be converted, it will be mapped into the taxable profits. And these will be the certain types of adjustment like accounting profit as per IFRS, then disallowable expenses. We have discussed like fines and penalties might be, we have already deducted to arrive at the accounting profit, it will be added back. In the same way, tax allowable expenses will be allowed, other taxable income will be added, other non-taxable income will be deducted, we will arrive at the taxable profits. So these two approaches are either we can apply the direct method or we can apply the indirect method to calculate the taxable income. Let's take this example. ABC company has the following amounts in its financial statements. Annual income is 30 million. Cost of goods sold is 18 million. These are my operative expenses. Capital gain on sale of machinery is 0.5 million. Dividend income, interest payments, these data given. So based upon this data, if I'm calculating what is my accounting profit, so sales is 30 million, cost of goods sold is 18 million, GP is 12 million. These all are the accounting expenses. Then after adjusting this other income, interest expenses, profit before tax is 4.65 million. This is my accounting profit. From this accounting profit, so basically I have tried to calculate taxable income or taxable profits by applying both methods. So in this is my direct method. In the direct method, I can take sales, I can take my cost of goods sold, I can take taxable allowable expenses. Then I arrive at 2.28 million is my taxable income or taxable profits by applying direct method of calculating of taxable income. But if I'm applying indirect method, under the indirect method, I have taken 4.65 million as my base. So basically, whatever the accounting profit was, I have taken it as a base. Then I have adjusted for the permanent differences. These were my permanent differences like gain on the sale of capital assets, dividend income, penalties. I have temporary differences. After adjusting these temporary differences, then tax allowable expenses I have adjusted. I arrived at 2.28 million. So we have learned basically till now why we are calculating taxable income, how we are mapping our accounting profits into the taxable profit, or how we are calculating through a direct method. Till now, just for your kind information, we have not discussed the requirement of the UE corporate tax law. Just we are understanding. So basically, what is accounting profit, taxable profits, how to calculate the top taxable profit, what are the approaches for this. So let's discuss what is the requirement of the UE corporate tax law. We just set the foundation. After setting the foundation, we are in a better position to take off. So Article 20 of the UE corporate tax law says, taxable income of the taxable person shall be determined separately on the basis of adequate standalone financial statements prepared for financial reporting purposes. This is one thing is very clear, that every business is liable to prepare the financial statements. One thing is very certain here. Every business is liable to prepare the financial statements. Law is not asking audited financial statement. Law is not asking certified financial statement. Law is asking financial statement. So they said taxable income will be calculated, will be determined on the basis of standalone financial statements. So businesses will be liable to prepare the financial statements. From the financial statement, Article 22 of the law says, taxable income for a tax period shall be the accounting income for that tax period, and to the extent possible adjusted for the various income. So they are asking, take the accounting income. There is basically accounting income and taxable profit. Accounting profit. Take accounting profit, make adjustment, arrive at the taxable income. So this means, what does it mean? This means the law is asking us to apply the indirect method of calculating taxable income. So we need to calculate, we need to prepare the financial statement, we need to calculate the accounting income as per applicable accounting standards. We know this, the IFRS are applicable in the UAE. So we need to prepare the financial statements based upon the applicable IFRS. And from this financial statement, we need to take the accounting profit. We need to adjust the accounting profit. We need to apply the indirect method. Then we will arrive at the taxable income. So Article 20 of the UE law has bound the taxable person to apply the indirect method to calculate the taxable income. So from the wording of the law, this is very clear. Whenever they are asking to prepare the financial statements and adjust the accounting profit, means this law is bounding to apply the indirect method to calculate the taxable income. So what type of adjustment? These are the various types of adjustment it has been given in the law. These adjustments are unrealized gain or loss adjustment. We will discuss all these adjustments in our next lecture. For the time being, I'm moving forward because our core discussion is not about the adjustment. Our core discussion is how to map the accounting profit into the taxable profit and which method we need to apply. Exempt income, it needs to be adjusted. Intra-group transfers needs to be adjusted. Deductions which are not allowable for tax purposes, like we have already discussed, 50% of entertainment expenses not allowable. Fines and penalties are not allowable. It needs to be adjusted. Adjustment for various with related party and connected party. Transaction can be with the related party, connected party, below the market value or above the market value. Law says we need to set the prices based on the arm's length principle. So we need to adjust the transaction with the related party or connected person. We will discuss in our next lectures. Any incentive or tax relief needs to be adjusted. Any other adjustment that's specified by the minister, this needs to be adjusted as well. So what we have discussed, apply indirect method, make these adjustments, arrive at the taxable income. This one thing is very important while applying the IFRS and the UECT law. If there is any conflict between these two, UECT law provision should always be precedence over IFRS. This was already discussed as well. So if there is a difference in between accounting principles and if the difference in between accounting principles and UE corporate tax law, the provisions of the UE corporate tax law will prevail. So preparation of financial statement, this is important. As we discussed, every business, every taxable person is liable to prepare the financial statement. In the law, there is no compulsion to get the financial statement audited. However, Article 54(2) of the law empower the Minister of Finance to issue a decision requiring category of a taxable person to prepare and maintain audited or certified financial statements. So ministers have the powers. If they're asking certain category of the business, they need to maintain the audited financial statement, they will have to do. But right now, there is no requirement in the law that the business needs to maintain the audited financial statement. Law is asking they need to maintain the financial statement. IFRS requires the financial statement may be prepared by the accrual basis of accounting. We all know this, that financial statement required to be prepared on the accrual basis of accounting, but minister can prescribe the circumstances under which a person may prepare the financial statement using the cash basis of accounting. Again, we need to wait. What are the circumstances under which we need to prepare the cash basis of accounting? And if one business is preparing the financial statement by applying any method, and they wanted to change the method, and they wanted to go back to the accrual method, in this situation, they need to take approval. And once it will be approved, this approval will be effective from the commencement of the tax period in which the application is made, or from the commencement of the future tax period. The summary of the discussions, this is the summary of the discussion. Prepare the financial statement using the accrual basis of accounting unless circumstances allow you to use the cash basis of accounting. Then get the financial statement audited if required by the minister. If not, then you are not liable to have the audited financial statement. Make these adjustment we'll discuss in our next lectures. Calculate tax up to 375,000, 0% tax, beyond that 9% tax. Submit the return and pay the annual tax. This is over from my side, and if you have any question, you can speak to us. You can drop us an email. My name is Mahar. You can drop an email to Faiza Hashmi. She is our tax director. You can tax manager, assistant tax manager. You can drop us an email. You can give us a call. Definitely will come back. So we listen as usual. We understand. We deliver. If you have any question, you can drop us email at info@kresscooper.com, or you can give us a call as well. Thank you very much for your patience. Thank you very much. Appreciate it. So if you have any question, you are most welcome. I got the question. Did not receive PPT of last session as yet. Kindly confirm you will share. For sure, I'll share. Apologies for this, honestly. So just drop me an email. I'll send you for sure. Will there be any benchmark for depreciation rate? We need to wait for the regulations. We cannot say anything conclusively right now. Once the law will be introduced, once the regulation will be introduced, they will give us clarity about a lot of things. We need to wait for the regulations. Once the regulation will be introduced, they will give us a clarity about a lot of things. I believe depreciation rate will be part of this as well. So there's no other question. Any other question? You are most welcome. Okay. Harun is asking, what is the status of offshore companies? Offshore company, it doesn't matter. We have already discussed in the very, not first, second lecture. We need to apply the principle resident taxable person, non-resident taxable persons. Resident taxable persons are subject to tax for their worldwide income. We know this. Even the businesses are out of the UAE, but if these businesses are being controlled and managed from the UAE, still it will be subject to tax for their worldwide income. It doesn't matter. We need to stick to the basic principle. Are they resident taxable person? Are they non-resident taxable person? You can go back to our lectures. Lecture number 2, you can find it on our YouTube channel. You will find the complete lecture there. You will have a thorough understanding. If you have still any question, you can come back to me. Okay. Arun is asking, what will be the treatment of non-recoverable input tax? Non-recoverable input tax, it has been given in the law. This is the allowable expense. Recoverable input tax is not allowable in expense. Non-recoverable input tax is allowable expense. You can deduct while arriving at your taxable profits. Can you have this PPT? Thanks, Ajay. PPT email. Okay, I'll send it to you, Ajay. See when the procedure will be coming by idea. Hopefully, it should be in the first quarter of 2023. I believe it will be out in March 2023, or maximum we can go to April, because a lot of businesses on that corporate tax is applicable from starting from 1st of June 2023. They must have some sort of time to implement the corporate tax properly. I believe it will be announced in the first quarter of 2023, or maximum in April 2023. Okay, guys, any other question? No. Okay, thank you very much. Thank you for your time. Have a lovely day. Thank you. Bye-bye. Okay, one more question is here as well. What is... Okay. Please send to, okay, this is your email. So prepayments or deductible expense. Does this mean actual payments or receipt of invoice? For example, rent paid to installment. Listen, Haseeb, it will be, I think it will be given more clarity in the regulations. Usually, as I mentioned, usually cash tax authorities follows cash basis of accounting. So if we are making a prepayments of assuming 100,000 today, 100,000 will be allowed as allowable expense to arrive at the taxable profit. But in the accounting books, it will be amortized. So in assuming the period is for 10 years, in the accounting books, expense will be 10,000. In the tax books, expense will be 100,000. So it will create, prepayments will create a taxable temporary difference. Due to this, you will be liable to pay less tax now, but in the future, you will be liable to pay more tax. So this is the reason prepayments are usually allowed on cash basis, but cash tax authorities usually follows cash basis. Accounting principle allow us to use accrual basis amortization principle. Again, we need to wait for the regulations on this. It will give us more clarity regarding the prepayments. The Amir is asking, taxable income will be adjusted for intra-group transaction. Is there any regulations of transfer pricing in the UAE? Yes, transfer pricing rules are applicable in the UAE, and taxable income will be adjusted for the intra-group term, because intra-tax group, like we have intra-VAT group, is the same way the businesses can have the intra-corporate tax group as well. Once the businesses will have intra-corporate tax group, a lot of conditions for this, like the businesses must have 95% voting rights, shares, controls, same financial year. Any person should not be a qualifying free zone person. Any person should not be a exempt person. Same principle, method of accounting. There, a lot of conditions are there. If all these conditions are being fulfilled, then businesses can go for corporate tax grouping. Once they're going for the corporate tax grouping, all intra-group transactions will not be subject to corporate tax. So it will need to be adjusted while calculating the taxable income. Yes, a second question is yes, transfer pricing regulations are applicable in the UAE. It requires that the businesses needs to apply arm length principle to arrive at the taxable income. Amar is asking, first time attended, but this is useful. What kind of this company? What kind of this company? I'm so sorry, I didn't understand your question. Hasib Sarfaraz, please answer. See, what is the question that you asked? Prepayment, I think I have answered it. Arun is asking, is there any limitation for the director remuneration? Director remuneration, for sure, there will be limitation. And again, we need to wait for the regulation, because I think they need to give certain amount or certain principle based upon this director remuneration will be allowed. We cannot go, otherwise every person will be taking the remuneration in million, taxable income will be zero, authorities will not be getting anything. Definitely arm length principle will be applicable, as I mentioned, on the connected person, on the related parties. These related parties these directors fall under the connected person, and arm length principle are applicable on this as well. So we need to, what type of amount they will allow, we need to wait for the regulation, but this is for sure, it has been given in the law that transfer pricing principles are applicable on the connected person and directors are the connected person. Okay, what will be the treatment of non-recoverable input tax? I think I have already requested. Non-recoverable input tax is allowable expense. Can we have this PPT? Thanks. What is the procedure? When the procedure will be? No, I think we have addressed all these questions. Did not receive PPT. Okay, guys, I think none of the question is pending. We have addressed every question. Thank you very much for your time. Thank you very much. Really appreciate it. Have a lovely day. Thank you. Bye-bye.